Amid a US-China trade truce and multi-billion-dollar deals between the US and the Middle East, US stocks have recovered to turn positive on the year. But what now? I'm Fiona Cincotta at StoneX, and to delve into this and more, I'm joined by Vice President of Global Head of Retail Dealing Desk, Alex Ridges. Thank you for joining us, Alex.
Hi, Fiona.
So with the markets having stabilised post-Liberation Day, what are the key indicators we need to be watching out for now?
Well, this is it. We went through last week, again, reasons to be positive, and I think they've largely played out. And so we've almost got rid of that phase. And so, I mean, certainly what I'm looking into is, first of all, what does Trump want? What's going to make Trump happy? And also what's going to give us that stability that the markets are wanting? So going back to to the first one, what does Trump want? I mean, I think, when we're talking about the key indicators that you said, we've got the big four. We've got non-farm payrolls, GDP, consumer price inflation, and retail sales. And I'm trying to cut these down again, go into what are we looking at? What are the first indicators that are going to show us the future, rather than some measures, economic data? It's happening. It's already happened. It's post, to put a better word for it. NFPs, I'm completely ignoring, because they've largely since COVID been incredibly stable. So when we're looking at what's driven the markets, go back to the 1980s, 1990s, noughties, everything was about NFPs. The market went crazy on a Friday afternoon once a month. But over the past, I'd say probably I started noticing it, say 6-7 years ago, it's really a bit of a damp squib now, which is disappointing, but other measures have come across. And I'm going to also say retail sales. When you look at retail sales, or US retail sales, they're oscillating around zero most of the time. There's a little bit of growth, but generally, zoom out, nothing interesting happens. So when this is talked about, retail sales, they're going to tell us what's happening in inflation-wise, I don't think they do. I think you can completely ignore it. So what does Trump want? He has put a big push to manufacturing. Again, he wants to see US manufacturing, and I suppose industry gets put in that bucket. So one thing I've noticed, which may actually help Donald Trump, almost without him actually having to do anything, is that industrial production has been, after years of just zero growth, a little bit up, a little bit down, we've finally seen it in 2024 starting to pick up. And this is early 2024, so almost before he even came to power. So that industrial production trending up, if that keeps going, I think we're in for another market boom. But of course, on the flip side, if that stops, that may have been some of the reason we've seen the market rally recently. And the same with manufacturing production.
And I suppose, where does inflation, so CPI, sit in with this? Well,
it was our chief market strategist, Catherine Rooney-Vera. She was the first one, even before Trump was inaugurated, to be shouting inflation as like the key measure. So I'm not going to chuck CPI in the bucket with NFPs and retail sales, saying you can ignore them. I'm almost treating that as that's monetary policy, and any drop in interest rates is good for growth and will be good for markets. So that's firmly important alongside other factors.
And I suppose, what else what else is going to show that the economy is stable in the US?
Oh yes, so thank you. It brings me on to almost the second measure. I'm looking at the producer price index. So this counters the consumer price index. This is almost input prices. What are the costs that producers, manufacturers are facing before passing it through to the wider retail base? And we saw very almost strange goings on in 2022, 2023. I mean, COVID obviously was, most of the stats I talk about, COVID was an outlier, it's massive down, massive up. But if we take that out of the stats, 2023, 2022, PPI was negative in most of those times, where it normally stays consistently positive. Now, in my mind, I'm saying this is what was driving the growth in financial markets in 23 and 24. Again, that idea that cheaper input costs lead to bigger margins, lead to bigger profits, more growth, more investment, that going round. And 2024, again, even though we saw market growth, PPI went firmly positive. So again, that reduction in margins. But then we've just recently seen the March figure. We've got PPI out later today for April. So the March figure is the first one that's turned negative since 2023. So in my eyes, another negative figure is going to be a really good sign that again, margins are going to be going up for producers, and and we're in for a good ride.
That's a really interesting lead indicator to be looking at. Yeah.
Yes, exactly. And of course, quite the opposite. If we return back positive, again, this thing, seems, this is why I like PPI. It seems to be quite a less sort of laggy indicator, or in the other way around.
Yeah.
It's in advance, and the market is lagging.
Yeah. Yeah.
Growth in 22 and 23 has led to growth in 23 and 24, and almost a high number in 24 has possibly sort of been causing the slowdown we saw before Liberation Day.
Yeah. And are you also looking outside of the US as well?
Yes. When we talk about indicators, again, I think it's too easy just to look at the same indicators in every country and go, right, well, it's the same around the world. But really, as I was saying earlier, US retail sales, they're important to big companies like Apple and Amazon, but actually they're massively global companies in themselves. So, really, while it's an important driver, it's not everything. So if we look at something like China, China retail sales should be way more important to Apple than actually US retail sales. So when we're talking about what's driving global markets, particularly US markets, it's sort of key bits from China. So retail sales is another is a fascinating one where, you go back to 2010, I know it's a long time ago, but we had Chinese retail sales up at averaging 18% growth. Ridiculous. And there's almost been a sort of consistent straight line trend down from 18%. And I sort of plotted it earlier today that without any sort of upturn, we'd be hitting zero in 2027. So I think this has almost been sort of weighing on markets for a while. There's sort of worry, where's the Chinese consumer going? The good news is, I think, last year we saw that bottom out at about 2%. And now, again, we've seen China stimulus, and we talked about that before, that, again, with sort of Chinese rates coming down and just various stimulus measures, we've seen that bottom out from 2%, and we're now coming back close to 6%. So we've got the Chinese retail sales coming out, I think it's early Monday morning next week. So a drop in that would be a big worry. And again, a big number would be great. The world economy is back on track. So that for me is infinitely more important than US retail sales.
And is there anything else about China?
Industrial production. So again, I know we've talked about US industrial production. It seems whatever around the globe, this seems a fairly important measure. Similar to resale sales, again, we've been on a downtrend, ever since sort of the early noughties. And we saw sort of 2023 become a low of around 3% growth, which is, still not terrible, but not like the sort of 10-12% we were used to seeing. And as we've gone through to the end of 2024, we're just beginning to see an upturn in that industrial production. So we're now hitting levels around just below 6%. And I think the industrial production figure for April predicted on Monday is due to hit 6.4%. So if that's true, again, really good sign. If not, it's a real worry. So I think next week's going to be really fascinating, because we're going to wake up on Monday morning and have these two big figures out of China guiding the world economy.
And finally, what about Europe? I feel we should talk about Europe.
You're right. I think in some ways it could be a whole other video where we talk about Europe. But in general, markets don't seem to take notice of European values quite as much. They do Eurozone as a whole, but they still don't move the markets like big US numbers, big Chinese numbers. If you were to ask people, what was going on with the Spanish economy or the individual ones, they'd struggle to tell you unless they're an expert. So again, we should probably do another video on what's driving Europe. But generally, with being more consistent, what I'm really caring about in Europe is energy prices, and energy and food prices, I suppose. That's been the big sort of driver of not recession, but again, reduced growth, with costs going to the average consumer going up so much, and the European consumer not being particularly confident. So rather than sort of specific economic data, I'm looking at energy prices, and crude oil is down in the doldrums now, which I think is great. So again, where crude oil goes, where natural gas goes, that's going to drive Europe. And then finally, the Ukraine war. Again, an end to that means lower food prices, and that's going to drive Europe higher, if so. And if not, obviously the opposite.
Excellent. Well, thank you very much for your analysis, Alex. Great to have you back on.
Thanks, Fiona.
For more videos like this, please do like and subscribe.